Today, we're diving into an analysis report on new BURU, ticker BURU, titled, Is BURU the Next Big Runner? It assesses the company based on its technicals, short squeeze potential, and a few fundamental catalysts, basically positioning it for a big reversal.
Right.
The analysis makes a strong case for upside. But, well, we need to make sure the whole thesis can really stand up against some pretty significant financial headwinds.
Yeah, that's putting it mildly.
So, the core of the issue, it seems to me, is this massive conflict. On one hand, the report is super bullish, right? It's a big runner thesis built on the Lyocon acquisition and this Technip partnership. But then you get to the summary and it reveals these just staggering liabilities. We're talking a trailing 12-month net loss of over $34 million.
And a negative operating income of $13 million.
Exactly. And the two ideas, they just feel very, very disconnected in the current report.
They really do. And I wonder if we've thought about the impact of separating them like that. You know, by putting the huge financial hole in one corner and the promising catalysts in another.
It almost makes the catalysts seem like optional extras.
That's it, like a bonus, not a survival plan. The analysis needs to establish a clearer logical bridge explaining how the recent catalysts mitigate the severe existing financial challenges. I mean, the weakness here is really structural. By putting that huge negative number, that $34.5 million loss only in the closing summary.
Way at the end.
Way at the end. The main body of the report, it doesn't give you the context for why you should believe these new deals are powerful enough to overcome that kind of financial drag.
I get that. So the reader has to do the work of connecting point A, the loss, with point B, the solution. But let me push back a little.
Sure.
Couldn't you argue that the market has already priced in that $34 million loss? I mean, the stock's trading at what, 23 cents? So shouldn't the report just focus on the upside?
That is a great question, and it really gets to the heart of it. Yes, the market is pricing in the loss. That's why the stock is so low.
Okay.
But for this analysis report to be truly convincing, it needs to quantify the restorative power of the catalysts. The way it's structured now, it suggests the catalysts are just adding to the business.
When they're actually trying to save it.
Precisely. This is a turnaround analysis, not just an expansion story. So my suggestion is to integrate that financial context directly into the fundamental catalyst section.
So right up front.
Right up front. The report should explicitly frame Lyocon and Techne not just as growth opportunities, but as necessary, high-impact interventions designed specifically to plug that $34 million hole. They aren't the icing on the cake.
They are the cake.
They're the medicine. To give a concrete example, instead of just saying the Lyocon deal is a massive step toward global expansion, you need to detail how its revenue diversification directly targets that loss.
So you'd want to see actual numbers?
You'd want to see an attempt. For example, the material could estimate that the 23-cent entry price is based on the market knowing about the losses, but what it's not pricing in is the recovery potential from these new deals.
Okay, I see.
You could outline how Lyocon is projected to maybe mitigate $10 million of that loss in the first year, or how a single Technique contract could close the rest of the gap. Quantifying that impact is what turns this from a speculative idea into a robust turnaround analysis.
That framing completely changes the gravity of the report. It elevates it from, here's some good news, to, here is the precise mechanism for survival. It adds a ton of urgency. Okay, let's switch gears a bit to the quantitative side. We have to look at the short interest analysis, which is obviously crucial for this whole runner theme. The report flags a float of about 178 million shares, short interest at 9.7%, which is about 17.7 million shares. And it says this puts BURU in a pressure zone.
Pressure zone is interesting language. I mean, the data is compelling on the surface, but when you're dealing with a float of 178 million shares...
It's a huge number.
It is. And a 9.7% short interest against that backdrop, it demands a much sharper quantification to be convincing. The analysis must provide a stronger justification for labeling a stock with 178 million share float and 9.7% short interest as a high probability runner. The weakness here is that the connection between the huge float and the short interest, it lacks the quantitative depth to really back up that aggressive squeeze setup theme.
Right.
Sure, 9.7% is elevated, but in this kind of low-priced, high-float stock, that percentage alone can be misleading. Volume can get really compressed under $1.
Meaning the shorts aren't under that much pressure unless volume just explodes.
Exactly. If only a small fraction of that 17.7 million short position is really feeling the pain, the whole squeeze thesis gets a lot weaker. We need to define what it takes to actually move a float this big.
I think the missing piece is context, right? A 10% short interest in a low float $10 stock is a completely different beast than 10% in a sub-dollar stock with a massive float.
Completely different.
Isn't something like days to cover a better metric here?
Absolutely. And that leads right to the suggestion. The report says volume needs to be well above its average, which, is vague.
In the millions.
In the millions. That needs to be made actionable for someone reading this analysis. The suggestion is to clarify the required volume dynamics. The analysis should establish the necessary velocity, or maybe the volume multiples needed to absorb 17.7 million shares of covering.
And push it through those resistance levels.
And push it through resistance. For a concrete example, define what a breakout actually looks like. Instead of just millions, specify that you need to see, say, 3 to 5 times the average daily volume.
So maybe 15 to 25 million shares in a single day.
Exactly. That's the kind of volume needed to breach that critical 25 to 27 cent resistance zone. And then you have to explain why this 9.7% is so potent.
Say 80% of them shorted above 40 cents, that massively increases the pressure as the price moves up. You have to use the large float not as a weakness, but as a measure of the scale required.
That really sharpens the focus. It turns a generalized squeeze idea into a precise, mechanical prediction. You're giving the reader a clear threshold to watch for. Okay, moving to our final point, risk. Every good analysis needs an equally good risk assessment. The report currently limits its risk to technical support, basically saying, if support at 20 cents breaks, the runner thesis is invalidated.
Which makes sense as a technical stop loss, of course. But given the fundamental story we've been discussing, this desperate need to fix a $34 million problem, the real risk isn't technical.
It's operational.
It's operational. The evidence points to a different kind of risk analysis. The risk assessment should be expanded to include fundamental risks directly associated with the company's financial state and the success of the new strategic initiatives. The weakness is that focusing only on that 20-cent line gives you a very narrow, very reactive view of risk. The company just lost $34 million. The stock is down 77% year over year.
Yeah.
The primary risk isn't a line on a chart failing, it's the operational failure of the Lyocan integration or the Techne contracts not materializing.
A support level is just a lagging indicator of that fundamental distress.
That's a perfect way to put it. If the Lyocan deal hits a major snag, the stock doesn't slowly drift down to 20 cents. It gaps down instantly, and that technical stop becomes useless.
That is such a critical distinction. We see that all the time. In a turnaround play, the execution of the strategy is the real killer. The failure of the fuel source has to be the central risk, not just the line on the chart.
Exactly. So my suggestion is to introduce fundamental, forward-looking risks into the discussion. A truly robust analysis has to admit that the entire bullish case hinges on these deals working out. If they falter,
The technical breakdown is just the aftermath.
it's the effect, not the cause. For a couple of concrete examples, the analysis should spell out 2 key non-technical risk scenarios. First, what I'd call acquisition risk. What happens if the Lycon deal runs into cash problems or integration issues that actually increase the $34 million loss before they can generate new revenue?
That would be catastrophic.
It would confirm the market's worst fears about cash burn. Second, what you could call contract risk. What if the Techne partnership just fails to land any big government contracts in the next 2 quarters?
The favorite theme for retail investors just evaporates.
It evaporates, and you're left with the same old negative operating income. Defining these operational risks shows a much more sophisticated understanding of the situation.
That strengthens the analysis report so much. It prepares the investor for the actual reality of these high-risk turnarounds. It's clear that the financial necessity, the volume math, and the operational risks all need to be woven into the core argument. So, to summarize, we've really landed on 3 key opportunities to refine this analysis and make that big runner thesis much more robust.
I think so.
First, you have to explicitly connect the catalysts, Lyocan and Techne, to the absolute necessity of overcoming that $34.5 million loss. Frame them as interventions, not just bonuses. Second, provide a much stronger quantitative case for the short squeeze. Contextualize that 9.7% short interest against the huge float. Define the volume multiples needed to actually trigger a rally.
Be specific.
And finally, expand the risk analysis. Go beyond the 20-cent technical level and include the fundamental, operational risks, the risk that the new strategy simply doesn't work out.
Absolutely. You have a fascinating setup here.
It's a great blend of technical action and this really compelling fundamental potential.
It is.